So we have Chris Wood from DTZ, who runs this market on the broker side, and that's going to be something we'll talk about because of the evolution of the DTZ world. Mike Drew, structured development, 25-year veteran. Right now the big project is the new city, but he's been involved in a bunch of public infrastructure and other projects as well that we'll talk about. Ryan O'Leary runs Duke Industrial. It's about a 12.5 million square foot portfolio roughly, including a new development acquisition. And Chicago, obviously, a pretty significant industrial world. Alan McHughes with Colliers and has been in the demand side for a long, long time, very successfully. And we'll talk about that. And then Drew Neiman, I think we're going to start with. Because if we didn't, he'd be probably mad at me. But, you know, just quickly, as Jerry Sullivan introducing this event said, everyone's pretty enthusiastic and energetic about excuse me, what happens or what 2015 is looking like. You know, I think just based on some of the stuff I've read, 2014 ended up as the best really growth year in 10 years. Everything seems to be humming. There's a lot of capital. It's affordable. There's affordable and available debt. Unemployment's at pre-recession levels. Income gains, coupled with both lower energy costs and even some lower food costs, are really producing high consumer confidence. Contrary to what Howard Tolman said, maybe no one at 1871 is buying cars, but auto sales have improved for 5 straight years as well. You know, globally there's some issues, but domestic stability is pretty significant. We've talked about, you know, there's a multifamily product. Steve Fifield said a couple years ago that product was in the 7th inning. Well, they're still singing, you know, "Take Me Out to the Ball Game," because that's still cooking. Hospitality, we're adding hotel rooms, and, you know, with low fuel costs, people are coming to Chicago and staying domestic for travel, so that looks like still a pretty solid asset class. And healthcare, real estate, with our aging population and everything else that's going on, pretty solid. We're not going to cover those specifically. We're going to dive right into kind of a very exciting thing. We were talking about cycles. Drew has been around for a number of cycles. Cycles, I used to be 7 years with information. Drew likes to pin him at 5. So since '85, I think, maybe starting with 190 South LaSalle, Drew's been on the product, you know, on the supply side with office buildings, and right now the most kind of visible thing that's going on downtown is 150 North Riverside, O'Donnell, and kind of Drew attracting tenants. So Drew, just kind of talk to us about maybe the differences, what you've seen through that span, and what's happening today on the you know, new development office side downtown.
Thanks, Dean. Can you hear me? Is that good? You know, I mean, I guess the good news is that there's a development cycle to talk about, which I think is one of the indices, if you will, of what I would call a healthier market. You know, we just had a huge absorption in the 4th quarter of 14, getting us down to a 12.6% direct vacancy. Sublease, which normally hangs in the 2 and can be as high as 5%, is at 0.6%. So again, these are good signs that show that the market's, you know, kind of tightening up. But the one, you know, that really gets it going is when you start to see cranes and new construction going on. That starts to tell you that people believe that, you know, replacement costs and buildings can be leased at that, buildings can be sold at that. Investment sale activity through 2014, 20 properties were sold for over $4.5 billion, and we've gotten to new lows in cap rates, sub 5, in terms of cost per square foot, north of $460 a foot. So all these things show investors and developers that if you're going to get in, you can get out, and that's the key. You need to know there's an exit, and so right now, you know, Danny was talking about these cycles. He's right. I started with John Buck in 1983 after spending 6 years as an architect. So I knew kind of a little bit about design and nothing about making money. sorry to those designers out there. I'm sure it's different this now, but it was tough then, and I wanted to party with all my real estate friends, so it was really tough. But I got in with John Buck, we got going, and Danny's right, you know, there has been cycles and kind of starting, so you know, when I got there, it was like 1983, there was a big, you know, kind of a push that was 333 Wacker and the Merck and 1 South Wacker, and things started to go, and 190 LaSalle, and so cycles, traditionally, the real estate development cycle was kind of 4 to 5 years, because it takes a building 24 to 30 months to build, depending on if it's 52 stories. But you got to design it, you got to get financing, so it's really 3.5, 4 years. And so that's kind of how things had moved, you know, since then. There's been 2 skipped cycles, 2 skips to the cycle, if you will, between that time and today. And that was 1990 to almost 2000 was the first kind of skip in the cycle. We went 8, 9 years. And the second is because of the meltdown in 2008. The last buildings were delivered in 2009 with 155 and 300 North LaSalle. And now the next ones we're talking about are going to be developed in 2017. So you're looking at 8 years roughly between the last buildings. And I guess that also bodes well for demand starts to increase when you skip a cycle. So this could be a fairly active development market. You know, start off with 1000 West Fulton, where Google's going, even though it's not a brand new building. I mean, what they did to that cold storage building might as well be a brand new building, and the cost they're putting into it. And they're about to open and doing very well and almost entirely pre-leased. And then Hines with 444 West Lake, which landed DLA and McDermott, 2 big law firms to get going. And then John McDonald at 150 Riverside, which landed William Blair and now Hyatt, Pocinelli, in Victory Park. And so I can tell you, in this market right now, with the activity that's out there, I see at least 1, if not 2 more buildings possibly beyond those buildings going in this cycle, which would be, you know, well, right now we were 2.7 million under construction. That could be north of 4 million. Now, CBRE, who I work for, has the market at around 126 million square feet. So I guess you got to always kind of know what's the denominator before you start talking about what the numerator is. So that's not crazy, but I will tell you that's a lot of activity for what we've been used to date. And you know, and I think it bodes well for you know, for the brokers and developers and investment sales. It really kind of spurs everything all at once.
Thanks, Drew. So Ryan, in the industrial world, where, you know, all of the dynamics that Drew talked about, low capital,
yeah, I know dock doors and, you know, concrete floors aren't quite as you know, sexy as downtown skyscrapers. But, you know, Chicago is a huge industrial market. It's a 1.3 billion foot market, the largest in the country, and it's we're back. It's firing on all cylinders right now. 2014 was a great year. You know, we had our vacancies for the overall market dropped to 7.75%, which it hasn't been below 8 since 2001. So we've really come back a long way. That was on absorption of about 18 million square feet, which is, you know, the strongest it's been since 2005 in prior cycles. So it's really coming back strong. You know, space options for the big users are narrowing, so we're seeing a lot of rent growth, which has always been a little bit of the knock on Chicago as the development starts. It really pushes down the rental growth here, but we've seen it this year, and we've seen an abundant amount of capital come into the market. $1.85 billion worth of investment sales happened this year in Chicago, which far exceeds anything we've had on the prior peak, even 2007. So it's really come back and come back strong.
Staying on the supply side, Michael, you have a development that's, you were talking about some of the fundamentals changing or new dynamic of retail, in both investment and you know, on the rental side. Talk a little bit about what you're doing.
Yeah, Danny, we have what's probably the poster child for riding out a cycle. We've been working on New City, a $270 million mixed-use development at Halstead and Clybourne. For about 8 years, we refer to it as our overnight success story. North and Clybourne is an established retail corridor, and retailers are much more than office tenants, are location dependent. They look for sales per square foot, co-tenancy, demographics, and traffic counts. And if you have those, they generally want to be in that area, and that's what's happening in the North and Clybourne district. That goes for urban locations in general. Chicago, #1 retail street, of course, is Michigan Avenue, and Clybourne corridor is shortly behind it. So what you see are tenants that are typically open up on Michigan Avenue and then start looking for a second location, and they'll come out to that district like Nordstrom Rack. What's driving it is institutional investment, and that's driving the demand, and that's driving the development. GGP, for instance, has set a goal to transform the company in 5 years from a mall owner, one of the largest mall owners, to heavy investment in urban locations. They spent $3,500 a square foot on property on Fifth Avenue with the idea of getting a much larger footprint in urban areas. Georgetown Development in 2011 bought the Old Navy store on State Street for what at the time was the highest price per square foot, $511 per square foot. Acadia bought Lincoln Park Center in 2012 from us for $510 a square foot, and last week George Goods sold it to Georgetown for $1,000 a square foot. Yeah, I felt pretty good about that. I felt pretty good because we're building right across the street, so it's all right. And our partner John Buxbaum is focused on urban infill as well, and he's got a number of projects. And so I think that's the general trend, is that you're seeing institutional investment driving the development in urban areas.
Moving into the demand side, interesting, yesterday's front page, page 1 article yesterday in the Tribune, coyotes find prime real estate downtown. Approximately 2,000 coyotes are finding places to live downtown. At 125 square feet per coyote, that's almost a full floor. Junior Billing, I don't think that's a demand driver really for all the activity. What's happening? Who is it? What is it?
Actually, that's a sort of an interesting analogy because the coyotes weren't the suburbs, and now they're coming downtown.
That's a trend, clearly a trend.
And I think that's sort of emblematic of one of the big drivers of demand downtown today is the number of firms that are bringing their people downtown, bringing their companies downtown, so they get access to, as Howard talked about, the knowledge worker, the young knowledge worker. So that's a huge driver. And just back to cycles a bit. Chris and I are on sort of on the user side, and I've been doing this since '89. And I sort of think of it as not really development cycles, but what are the crash cycles? And you sort of had the crash in '91, '92. The refrain from Sam Zell was sort of stay alive till '95, right? And then it slowly came back, but then you had the tech boom, which I think is a different tech boom today than then. But you had and so the first crash in '92 was a supply side crash, really, a huge overbuilding. The next crash was really a demand crash, and then I think the next crash was in 07, 08 with another demand crash in the financial services industry. As Danny, you mentioned, the economy is doing very well now. You've got an uptick in manufacturing. You got all people coming downtown from the suburbs. Professional business services, I think, are they're growing like crazy. There's something in Plains that had 20% of leases are from tech companies, but even a bigger proportion are from professional service businesses, not law firms. So I think you got a big demand, increase in demand, which is why rates and rental rates are going up and vacancies are going down.
Chris, when we were talking, in preparation, the suburbs, you're a little more bullish on the suburbs than just saying that, everyone's moving out of them and coming downtown.
Yeah, no, first of all, I'm really bullish on that dating and donut site that Howard was talking about. There's fundraising going on in the back. Yeah, I mean, there was 1 million square feet, or $1 billion of investment in the suburbs in 2014 in the office side. So somebody's seeing value. 4 million square feet of leasing and 500,000 square feet of net absorption. I think there's still a reason why companies locate in the suburbs. Proximity to executive housing is still real. O'Hare Airport, proximity to customers. I think there's a real trend of some users coming to the city, not in entirety. You know, the Hillshire coming downtown, and the Google coming downtown. That's there. I've got a client. I did a project with you, Ryan, about 4 years ago for 40,000 feet in Rosemont. We just opened 5,000 square feet downtown Chicago to get after that 20 and 30 something worker. But suburban Chicago, I think, has got a lot of legs, and I think that as we look at 2015, we think that's going to continue. Vacancy rates are a little below 21%. I think they'll drop another point and a half. So I'm not writing the suburbs off. I think there's tremendous momentum both downtown and in the suburbs. I think for me, the thing we're looking at in 2015 is those big blocks of vacancy that are going to have to get absorbed over the next 18 months in the suburbs to keep them healthy. With some companies moving out of Chicago and some shadow spacing out there, like Alcatel-Lucent's got 500,000 square feet of Class A office space that's kind of percolating out there in the East-West corridor that they don't know what to do with yet. Zurich's got their 800,000 square foot build-to-suit going in the northwestern suburbs. There's a pocket there that's going to have to get backfilled. So, I think that the suburban Chicago market's got legs, and we think there'll be some good things happening there next year.
Ryan, on your different product, although maybe talk a little bit about Duke's not in the office business in Chicago, if that was planned, just happened.
Yeah, I wouldn't say that was, a market-specific decision for Chicago. I think our company looked at it. We had a lot of data. There's two probably macro things that went into that. If you look at REITs, that have exposure to suburban office, they tend to trade at a stock multiple around 12. If you look at pure play industrial companies like Prologis, they trade at 22 times earnings. So there was a big, obviously, decreased value. So we looked at that for one, and then the second part of the equation was, we looked at 10-year transaction data, and across our system, to put a new tenant in into an industrial facility, we're long-term owners, so it's all about keeping the cash flow going, right? So if we looked at putting new tenants into industrial facilities across our company, we would have to spend on average 15 cents to get $1 in rent. For our suburban office assets, it was 35 to 40. So from a long-term investment standpoint, it was pretty easy to see the data and to start moving the company towards a more pure play industrial group, and that's what we've been working on for the past 5 years. So we exited Chicago as one of the first one. There was more interest in that portfolio than some of our other cities across the country with Blackstone sale, and I think we'll see more of us doing more of that across the country.
I just want to echo what Chris said. I think I wouldn't take the jury for the suburbs, but I think the trend is for companies, it's all about their people. And so the trend is now they think all the people are downtown. We just finished a labor study for a pretty big client of ours who's thinking, where should they be, suburbs, downtown, and what they found was there's a lot of good, great people downtown, so big supply, but big competition. So they actually started looking even to get deeper into the suburbs, and less supply, but less competition, less cost. So I think that's the other side of this demand equation. The labor side is, at some point, it's going to be a tipping point. They're going to say it's too costly. People are too costly downtown. Let's relook at the suburbs, and there's still a lot of great people in the labor market in the suburbs.
Interesting. We're talking about Hillshire Brands coming downtown, Google coming downtown. Both went to non-traditional real estate call, and Mike, one of your tenants, I think was one of maybe the first tenant at 1K Fulton. Geography, we talk suburbs, downtown, off, call it the beaten path, real estate. How do you look at the dynamic of what's happening with, the demand side?
Well, I think Sterling Bay has done a hell of a job in creating the Fulton district. they bought up a lot of the large floor plates in old loft buildings, which coincidentally the tech companies you referred to, as well as the more corporate brands like Hillshire, like high volume space, as Howard said, high volume, no ceilings, and big floor plates, and that's these old industrial buildings that create the cool factor that a company with excellent credit like Google desires versus something down in the loop. So I think that's made a big difference. And they certainly are moving out in neighborhoods where we're more active than, for instance, the Cleveland Boulder.
As a a little bit more macro with what's happened in the industry. Drew, you were U.S. Equities, now CBRE. Chris, DTZ, I guess is maybe more common worldwide, but that's undergone a tremendous. The industry's undergone a tremendous evolution, of acquisition, mergers, growth. Maybe Drew, it seems maybe more local in your case, but how do you guys see, the world from what's really a changing, Cassidy Turley, DTZ, TPG?
I'll kick it off and then go to Drew. I think M&A is going to ramp up in 2015. I mean, 2014 was a big year. It affected Chicago, CD, U.S. Equity, Savills, Studley, Johnson Controls, facility management, real estate businesses for sale, big business. TPG, our new owners, a private equity group, and they looked at, globally looked at the real estate and facility services business and identified a $100 billion fee base and said the top 5 players have less than 15% of that industry base. So they see lots of room to aggregate and build market share through acquisition. And I think that that's going to ramp up in 2015. The war for talent is on, and I think in Chicago we're going to see quite a bit of that. Their vision for DTZ is to, with the Cassidy Turley acquisition, is to really round out the U.S. And so with that acquisition, suddenly we morphed into the $2.9 billion, 30,000 employee, 260 offices in 50 countries kind of company, and they want to do more. So I think it's going to be a theme, certainly moving into 2015. I think because of how that plays out, you're going to see more of an impact in Chicago next year. But I think it's really about there's market share to be captured through M&A and the services side of the business, and so they're after it.
Yeah, ours is like you said, Dean. CBRE is the largest real estate company in the world. They've got global plans and they've got national plans, and I'm pretty new, so I'm kind of not privy to all those. But I know that what they did here in Chicago with the acquisition of U.S. Equities, merger, however you want to say it, worked well locally because it kind of doubled their portfolio, and I think they needed some bolstering in certain areas that I think U.S. Equities were able to assist. But I think they're doing that elsewhere in the United States as well, in other cities. So I think it's strategic, but I think it worked well.
So it's more money in Chicago. Mike, we were talking earlier about coasts. Everyone knows the coasts are kind of the historical, institutional targets for investment. The Midwest, especially Chicago, is getting a lot of activity. I think both Ryan and you, Mike, were talking about that influx of capital. What it might do, cap rate, compression, ongoing, that really affordable. You see that changing in the near term? We're a favored, asset class in town.
Well, we sure hope it doesn't change. It's very good news for developers right now. Lenders are real happy. We're seeing cap rate compression, just to give you an example, and I don't know if Georgia Good is, CBRE is in the audience, but we did a small project. Kingsbury Plaza was, I think, about 50,000 square feet. PetSmart, Bye Bye Baby. We sold that at completion to Cole for about a 6 cap. That was in 2012. George was just getting warmed up since he took the Lincoln Park Center, which we had sold to Acadia, in 2012 for $510 a foot. He took it out to the market and they closed last week at $1,000 a foot, which is a 5 cap. So the cap rate compression makes us very happy, makes the performers look a lot better, and it seems to be from institutional investors from the coast who look at Chicago as a bargain. You know, we're not Cincinnati or Dayton, we are a pretty big city, and when they compare the price of real estate here, they see a bargain. So I don't see that hopefully ending since we continue to see cap rate compression.
Yeah, I mean, similar themes on the industrial side. You know, the knock on Chicago has always been rental rate growth, you know, overbuilding quickly and then lack of rental rate growth. So, you know, investors would always choose, you know, the coasts first. We lagged the coasts in this recovery. We're back, and we're seeing a lot of, you know, a wall of capital coming, trying to invest into Chicago. And it's not just the Class A, you know, product, it's B as well. There's tons of new players into the investment arena with private equity, doing a lot of B purchases. And, you know, from a cap rate compression standpoint, they moved down dramatically from 13 to the end of 14. We had a recent trade in the O'Hare market, which is the biggest submarket in Chicago, on a 6-year lease, traded a 5.05 cap. And that's $123 a foot on an industrial building. So it's, they've moved down dramatically. I asked, you know, the top 3 investment sales brokers if they thought we would break the 5 cap barrier in Chicago in 15, and 2 out of 3 that responded said yes. So I think we're gonna, you know, continue to see, you know, compression on the cap rates. There's just a tremendous amount of capital, and you know, that inflow of capital is just opening up, you know, a lot of opportunities for merchant developers as well. I mean, to Howard's quote, you know, capital, you can get it anywhere. Right now, there's tons of equity available. It's really opening the doors so the merchant builders can get development out of the ground. And they know they'll be able to trade out of it, whether it's, you know, through the lease up on the demand side, but the takeouts are there too. And we're seeing a tremendous amount of that where, you know, developments will be brought out of the ground and sold before they're even leased.
Multifamily has been trading below 5 caps for over a year.
Yeah, I don't know if you saw in the newspaper, I think it was a day or 2 days ago, Ivanhoe Cambridge bought this tower in New York. I want to say it was 4 Bryant Place or Park. When I did the math, I think it was $1,650 a foot for a 1.2 million square foot, you know, class.
We haven't hit that in Chicago yet.
No, we're at 650, so there's a little bit of a delta to work on between the coasts.
The strong capital markets are great for users as well, especially large users, because all of a sudden, if you're investment grade or close, you know, you can really leverage the aggressive, you know, the aggressive capital demands that are in Chicago to get a lower rental rate. Normally, you know, if you're at an 8 cap, you're at, you know, $100 a foot, you're at 8 cap, and all of a sudden, if you're equal to a 6 or 7, you're just lowering your rental rate from that standpoint.
But on the flip side, and I totally agree with what Alan said, what we're from the user side, what we're kind of looking at though is a feeling that there may be some artificial upward pressure on rents in Chicago, driven by new owners' return on investment criteria. For example, if rents across Chicago last year downtown went up 5 or 6%, we track when a building trades, it jumps 15, 16, 17%, at least on the quoted side. In the building one day is the same as the building the next day. The difference is ownership expectations. So what we're looking at really closely is, are those new rents achievable? And how much of that is really supply-demand based versus capital markets based? And it's at least my feeling that some of that is baked in as expectation that may not be achievable in some of the trades we've seen. I mean, $4 billion of product changed hands in 2014. I think there's probably going to be another $4 billion in 2015, even with a slight interest rate increase later in the year. But to me, it's can you achieve those rents? And that's what we're really going to watch closely.
There were a couple interesting, maybe a half a dozen buildings last year. I did notice that were purchased maybe 18 months ago, 24 months ago at 93% leased, and 18 months later they were 85% leased, and they were bought, you know, for more on a per square foot basis. So vacancy is opportunity once again as opposed to risk. So there is a belief that demand and, you know, rent pressure is a real thing.
I think it just goes to, you know, investors are sort of chasing yield, so I think they're now in a state where they're sort of overbuying a bit.
Yeah.
They're trying to plug rates, justify their purchase.
And some of these new owners they're paying such big numbers. I mean, the sense of it is they're long-term owners, right? Getting in and getting out quickly, I think in this kind of environment is more difficult than if you had bought it 2 years ago. That's good for tenants because they'll be making investments in property. They're going to have long-term ownership and operational horizons, which is good for tenants. So I think the dynamic of who's owning product is changing a little bit, and I think that's good for Chicago because I think they're long-term stable ownership positions just because they're buying at a number that's hard to exit in the near term.
Yeah, I mean, if you're an institutional buyer right now acquiring any sector, you hands down believe there's rental rate growth coming, and you're underwriting to it. There is no way you're buying at these cap rates without that being defined.
And the question is, what happens to cap rates when the Fed starts bumping rates toward the end of this year? So they sort of indicated that, you know, all of a sudden, you know, right now I think the spreads are around 400 basis points, a little over between treasuries and national cap rates. So as treasuries start to bump up, what is that? Does the spread lower or does the cap rates go up?
Can't go lower, right? I mean,
I don't think the cap rates will bump up much, honestly. I think they'll come down here at the beginning of the year a little bit and then they'll level off. I don't think as the Fed raises that the cap rates are automatically going to jump up. And it's the flow of capital. I mean, you look across the country, like Germany's, I think 10-year treasury is at 42 basis points. I mean, investing, you know, money in commercial real estate in Chicago doesn't look like such a bad return. So I think those spreads will stay thin.
Moving for a minute public to, you know, Mike, you have a lot of history building kind of public stuff. There's a new governor, you know, Chicago, Illinois, I don't seem to be in great shape. Businessman in Springfield now, Rahm Emanuel's pretty business, you know, pro-business Chicago, but, you know, infrastructure stuff. You were talking about some of the things you have to do, or a private developer has to do, and there's this affordable housing issue. Do you see policy? How do you see, you know, 2015 and forward relative to that kind of thing?
Well, Ron and the city are under tremendous pressure. The infrastructure is basically crumbling. They don't have the revenue sources, despite cameras and red light and every other fee he can get. It's very underfunded. What we're seeing on the development side is a little sleight of hand, whereas in the old days you might have been responsible for patching the street around your development at the curb line you disturbed. Now you are being forced to repave the entire streets surrounding because your trucks damaged them, or replacing water mains, or sewers that are existing city infrastructure. So it's there's more costs being borne by the development side of it. Permit fees have gone up, I believe, 50% in the last 2 years. The affordable ordinance will add cost of development. It sounds like voodoo economics to me. I don't see how they can expect to raise the money they're expecting by doubling the fee on something that hasn't produced to date, but that's another matter. So the infrastructure is not keeping up with the development cycle, certainly not in the Northern 5-1 corridor. Everyone says nobody goes there because everybody's already there. The traffic's miserable.
I think we're getting to where maybe we open up for questions, but last, you know, 2015, the way real estate moves looks pretty good. A lot of you talking about 2016 to 2019, so kind of getting through this cycle into the next one. Maybe every one of you, you know, just thinking through what we're looking at for the next, what's the next cycle like?
Well, let me just start kind of from the landlord perspective and maybe developer's perspective. One of the things that is absolutely happening across the board, suburbs, downtowns, whatever, is called densification. So people are trying to fit more people into less space, everywhere. Existing buildings, new buildings. And that can result in a lot of activity. It may not be net absorption, but it'll be people saying this building works or it doesn't work. And that's where landlords then have to look and say, boy, I better have the best elevators. I better, because things get more dense, HVAC, washrooms, all the kind of base building items that maybe you don't think about as much now better be relooked at and rethought, especially with, kind of the layout like Howard was talking about earlier, total cellular distributed system, a DAS system. So everybody's got to kind of step up their game to keep their tenants. They may give back space and shrink, but that may be the deal you're going to do. Or they're going to get up and move to a new space that's more efficient. They might even pay a few more dollars a foot because they can do it now because they've saved, 15, 20%. So what's happening is tenants are starting to look at this, and they're looking at it early in their lease cycle. So right now, this new development is really kind of, and some of these deals are stealing from 2018, 2019, and even some in the early 20s.
When does 150 South North Riverside open?
Excuse me?
When is 150, when does it open?
It opens January 17th.
Okay.
January 17th, but we're looking at people, it's not that, oh, look, is your lease up in 17? We've got those, and then we've got those that are 18 and 19, but are going to give back enough space or shrink and can do certain things and sublease. And I'm just telling you, no one's waiting. Don't wait for the door to knock. You got to get out there and you got to get on it. You got to be creative. And I'm telling you that if you wait, by the time you say, okay, great, now 19 and 20 and 21's here, who's here? They're already gone. They're already spoken for. They've already either re-up and stayed, or they've already moved early and they're subleased. And so now you've got to start rolling out 3 years beyond that. So it's an interesting bit of cannibalism, but we love it.
It's been going on a long time here in Chicago.
Well, I think Drew raised a great point. On the user side, we think of it more as sort of workplace performance as opposed to densification. At least the users do. But that's sort of a good reason to drop the, get a better play per square foot ratio. But I think that it goes back to labor again, and companies are realizing how important it is to attract and retain people. So they are looking more and more at what does the building offer, what does the space offer to do so. And I think you'll see companies sort of for the last 10 years, there were a tremendous number of lease restructures. People have been in their space a long time. So I think you'll start to see an increase in the amount of relocation by companies because they want newer space that allows for people to work more productively and efficiently. So I agree with you on that, on the overall result.
I think Chicago's industrial market is in a great spot, and I think we've got 3+ good years to run left. Unlike Drew mentioned, it's 3 to 4 years to get a tower out of the ground downtown, so you got to be real careful. On the industrial side, it's 7 months. So, Chicago has historically gotten into an overbuilding issue on the last cycle. This time around, right now we're delivering 6.5 million feet of spec product into the system. The historical average is almost 2 times that. So I don't think we're in any danger of it yet, but we got to keep a close eye on it. The REITs have been very conservative, keeping their occupancies up, which is definitely helping, and getting rent growth. I think Chicago will see in 15 a big benefit from e-commerce. Coming on the industrial side, technology is changing the workplace, but it's also changing the industrial landscape as well. Last year, e-commerce was 10% of overall national absorption, which doesn't sound like a lot, but 24 months ago it was 5%. So it's really coming on strong. It's changing the way we deliver and build facilities, and I think Chicago, with the changing political landscape, will be a big beneficiary of that in the industrial market for 15 and 16.
E-commerce is a threat to brick and mortar retail. There's winners and losers in that market, so we're paying very close attention to lease language, right to recapture, co-tenancy, et cetera, et cetera. And in a kind of a man bites dog story, the e-commerce companies are now starting to build bricks and mortar stores, Amazon, Microsoft. So that's something we're keeping very close to.
From 2016 to 2019, we're tracking about 16 million square feet of tenants in downtown Chicago that are rolling, and I think about 40% of those folks are already in the market. So Drew's point's a really good one. You know, Chicago forward presses, and people are already talking about the next wave of development. I think that Alan's point about consolidation of footprint's real. If you look at who's announced moves, tenants tend to move because the way they use space doesn't work. If it works, they can renew because it's cheaper. But DLA going from 260 to 175, Saypark going from 300 to 200. I mean, every relocation tends to be for less square footage, more efficient, maybe more expensive. That, I think, is going to keep blowing and going because corporate America used the recession, both law firms, consulting firms, the people that are the core of our market. They used 2008, 9, 10, 11 to like put the pain hat on and really make the changes they could make in their organizations and get smart about their business. Things have come back, coming back strong, but they're keeping to that discipline. So I think the square footage compression will have a lot of leasing. I'm not sure we'll have a tremendous amount of net absorption on the tech side. You know, how we're talking about, you know, $4, $5, $6 billion invested in Chicago. Tech leasing last year, I think, represented about 1 million square feet in Chicago, which is up exponentially over the last few years. I think we'll see some more of that. But again, for me, the big story, user matching up with capital markets, is going to be, are these new rents achievable over the long term? Because I think investor appetites and the frothiness of the market are one thing, supply demand's another, and I'm not sure they're going to match up in all places.
Well, thanks, guys. Is there kind of question-answer time? Michael, you have a question? We have a couple minutes, right? Do we have a couple minutes? Yes.
Hi, I wanted to ask you guys a little bit about some of the more unusual projects that are being converted right now, in particular the Chicago Sun-Times building, and also what's going on at the Sullivan Center. And it seems to me that's a reflection of the search for large floor plates. The fact is that River North, one of the big impediments there is a small floor plate building. And I'm wondering if you can speak to that as it relates to tech and seeing some of these larger, older boxes being converted.
Well, I will just say this, there is a finite amount of large floor plates in Chicago, okay? So the biggest being, let's call it the Merchandise Mart, which I believe is 200,000 square feet, I think, a floor. And then, you know, and then you work your way back to maybe, I'm not sure if the Sullivan Center, I think it might be about 60,000 square feet of floor.
Plus or minus 70. And I think the Sun-Times building rebranded River North Point, again, pointing out that River North is a legitimate address. I know that building is, I think, 80.
Yeah. So, you know, there's a few of those, and there's only so many. Then after that, they become, you know, you're going to have to develop new loft buildings, right? You know, if that's determined to be the driver, and that's what everyone's looking for, or a floor plate that maybe is two 25s that are adjacent to each other. So on one floor, it could be a 50 for somebody. On another floor, it could be two 25s for smaller groups. You know, you've got to kind of create some flexibility. But, you know, Chicago's, it's funny, it doesn't have as many large floor plates as New York does. I know I studied that for a while because I leased then Sears Tower, which is Willis Tower today, was 50,000 square feet. And, you know, I always thought that as being a large, you know, one of the largest floor plates in Chicago. And done very well. But the other thing, though, that comes with those large floor plates, if you remember Howard's comments, it comes with a lot of columns, and it comes with deep space, meaning not a lot of great natural light. It only gets in so far. So you got to kind of be really thoughtful about what it is they're truly looking for. Are they enamored with the old loft look and the grittiness and the soul of that? That's great. That's an existing building that gets renovated. If you're looking, you get a chance to do a new floor plan, a new canvas, but make it look pretty, you can do that. But what is it that you want? Is natural light more important? Is it the sheer size? What's the core configuration? I think there's still a lot of dialogue around that as to what would check all the boxes. And so it's a great question.
Yeah.
And I think there's not one answer.
Yeah, I would agree. I don't know if, I mean, Sultan Center seems to be a little bit different than the Chicago sometimes. Sometimes it might be more location driven because that's such a hot market. Sultan Center maybe is more of an economic play. I don't know if users are driven by large floor plates in particular, but large floor plate buildings tend to be more cost effective, like Hillshire and the Google building, at least the Google building used to be cost effective. But I think, yeah, the problem with large floor plates is as Drew mentioned, at River North there isn't anything even 30,000 square feet, so that gives us sometimes a big advantage.
Any other questions?
Yeah, I'll just speak up. You talked about the need for long-term investment in infrastructure. And by the way, great panel, really good insights in terms of controls and stuff. Pretty uplifting. I'm questioning the recent governor's decision relative to the Iliad Expressway and what impact that has on the region and Chicago and
The question is about the governor's recent...
The Iliad Expressway and your governor's recent decision kind of put the brakes on it a little bit, if you will, and what long-range implications that has for maybe the next business cycle.
From the industrial standpoint, everybody was obviously pretty attuned to whether or not that would go through. There was a lot of groups speculating and looking at the properties where it would connect down by Joliet and along 65, creating a new logistics corridor for larger regional to national distribution centers that wanted to, that right now are basically solely down on I-80. So obviously people will be watching it. I think they wanted to see that happen. And we'll see how the future holds. As far as for the region, I think it's a little bit of a drag. I think that would have provided a good boost to obviously some more investment and development.
Good. Thank you very much.
Outstanding panel. Thank you.
For a contractor, it's not enough to have the safest processes, or the most accurate estimating, or leading-edge technology and tools. For a builder, what's required is construction that's even more advanced in the form of experience and insight and leadership. At Leopardo, our people are among the best and the brightest in the industry, who build world-class projects across practically every major sector. At Leopardo, our people are the reason for our success.